a little bit better with the candle structure. And if you feel like you're having a tough time with it, just replay the videos. Repetition is key. Or you could get right direct with us and get the hands-on mentorship. So right now, I just want to show you guys the first indicator that you guys are going to be using outside of your candles. And what we have is this adaptive line, this black line. This black line is helping you gauge trend. So we want call trends above the black line. We want put trends below it. Very simple. Same way you view chop, because your candles are your first indicator. Don't use this black line first, use your candles first. So now that you see chop here, right, sideways movement, indecisive dojis, we know that if it's playing tight to this line and it's doing this, I'm now kicking back. I'm chilling. I'm not forcing no play. Now, when I start to see it work below it, now I'm getting myself ready to buy puts as long as my candle structure is set up like how we taught in the previous videos. So right now, this isn't the prettiest candle structure, but when you come over here and you look at this started doing what? An overextension of the wick. Red started fighting it down. You have to be aware of that. Now let's say we see this. What's happening? That sideways indecisive movement. What are we looking for? We're looking for the breakout above or below the indecisive movement. So in this instance, it broke above it. This is entry point. Tester, one contract. It's at 102.94 right here on the right. We're buying for it to go to the next number, which is 103 or 104. Same thing if it's going to the downside. We're looking for puts below it right here. We're looking for the breakout, right? I'm gonna make this one screen bigger and then I'm gonna show you the 30 minutes so you can see an entry point with a zoomed in on these 2 hour candles. So this is the 2 hour. Always look at what time frame you're on. This is the 2 hour. The same way we're looking for calls above this black line, adaptive line, we're looking for puts below the adaptive line with the proper candle structure. So now we see sideways movement here. What do? We look for the break below the sideways movement or above it. In this instance, it broke below it. Now this is a doji, right? You see a buying pressure pushing this up, green pressure pushing this up, and then what happened the next 2 hours? It opened up and the full control was the downside, right? So it's the same thing. This is just a gauge to help you with your puts and your calls, right? It helps you with when the market goes down, right? Let's say for instance here, when the market goes up and then it comes down and you may feel like it wants to turn around and reverse on you, but in reality all it's doing is coming back to test the adaptive line and work its way back up. So deeper into the video, you're going to learn that this is actually your compass. This is going to help you stay in plays. This is going to help you have a higher bias on your plays on top of your candles. Because if it's above the adaptive line on the 2 hour, you can see it run a good amount of times out of the trading week. You can see it run above that adaptive line or below that adaptive line for a good amount of days. Now, when you see it tight on it, you're doing the same thing. You're looking for the break above or below. But I'm only looking for the break above this until it fully gets above the black line with proper candle structure. This isn't proper candle structure. Look at the wick. Then look at the next candle. Then the next candle. The wick, before these candles happened, the wick that we were talking about, the overextension of the wick, showed that red was pushing this down. This wick right here was showing that red was pushing this down. And it kept pushing this candle down lower and lower and lower. But what do we have? We have our adaptive line that all of these candles are still above. You see it? So now what do? We look for it to hit a low in a black line and then find a low that we could get in so we could sell high. This is what this adaptive line is for. It helps us not be faked out if this is puts, or if I took profit up here and say I got in, and then I wait for it to go low, and then I buy for it at the low, and then I sell when it gets high. It's the same thing when it's going for puts, right? This is not the proper candle structure. Why? Because it's not fully above the black line. There's an overextension on this wick. And the overextension of this wick made what? A smaller candle, then made a red candle. Now it's sideways, indecisive, right? So now we look for what? The break below it. We look for the break below the sideways movement, and we look for a puts below the black line. So where would we be in? We would be in about right here. We look to buy high, sell low when it's puts. We look to buy low and sell high when it's calls. So we look for it to hit a low on the adaptive line, for it to bounce and buy for it to go up, and we sell when it goes up. In this instance, we look for it to break below the chop and buy high and sell it low so we could make our profit. So the adaptive line helps with that. The adaptive line helps with identifying if it's trending for sure to the upside, even though your candles do that by itself. But the adaptive line also helps when your candle structure looks weird, or it looks like it doesn't want to give it up no more, but it doesn't want to fully turn around. It's just looking to pull back and then bounce. So when it pulls back, you're looking to buy low, sell high. So if it's the low, if the low is down here, I'm looking for 102 calls. Now I'm in the money. Now I'm at 103.90, 104, 105. I take my profit. It goes over here. The number's on the right, 106.81. I buy for it to go to 106, or let's say it's right here. I buy for it to go to 106. It's at 106.09. Now it's at 105, 104. That's when you take your profit. If you bought it to go to 106 and then it goes to 103, and you bought for it to go down, you're big in the money. If you bought it to go to 104 and it's at 103, and you bought for it to go up and it's going up, and it goes to 107, you're big in the money. So, yeah, just use this as a reference of gauge for when the market looks like it wants to fake people out and just pull back and then come back in your direction. Use it for a gauge for confidence in the trend that you're in. Because especially the further away these candles are to this black line, like here, the stronger the play. The tighter the candles are to the black line, the weaker the play. So keep that in mind. Double back on your candle structure. Double back on what dojis are. Double back on what a breakout is. A breakout is above an indecisive movement. An indecisive movement like this is just resistance getting hit, then coming back hitting support, then hitting resistance, then hitting support, hitting resistance, hitting support, hitting resistance, hitting support, up, down, up, down, up, down. We don't want it to go up, down, up, down, up, down. We want it to go straight up, or we want it to go straight down. We don't want it to do up, down, up, down. Now, the next video, I'm going to teach you in detail what this up, down is, what chop is, what indecisive is, and why in detail why we play the breakout of it and don't play inside of the chop and let it guess the breakout, because that's like gambling. We want a for sure movement. We want it to see a breakout, bang, now I'm in. Now is it a good risk? It's a good risk. There's no more risk now. Now there's no more risk. I'm in so much in the money that my risk is me not taking my money. So next video, we're going to go into detail what support and resistance is, which is why this sideways movement is happening. Support pushes the market up, resistance pushes the market down. And chop is nothing but candles and money being stuck in between support and resistance. Let's get it.